Tomorrow morning at 6 a.m. Eastern Time, one specific thing happens that will determine silver's direction for the next 30 days. Not the opening bell, not a Fed announcement, not an earnings report. Something more mechanical, more precise, and more powerful than any of those events. And almost nobody in the retail silver community is talking about it correctly. At 6 a.m. tomorrow, Monday, April 21st, 2026, the full European trading session overlaps with the tail end of Asian market activity. Combined liquidity in silver hits its daily peak. Every data point, every geopolitical development, every institutional position built over the weekend gets repriced simultaneously in a single 90-minute window. Silver closed Friday, April 18th at $79.60. By 7:30 a.m. tomorrow, and that number will either be history, replaced by something significantly higher, or it will have survived one of the most loaded Monday morning setups in silver's recent history. Here is exactly what is waiting at 6 a.m. And I promise you, by the end of this video, you will understand why this specific Monday is unlike any Monday that came before it. Let me start with something that happened this weekend that is completely disconnected from every silver narrative you have heard this week. Today is Sunday, April 19th, 2026. And today, the U.S. Treasury published its weekly foreign exchange intervention report. Buried in that report, not in the headline, not in the press release summary, in the actual data tables, is a number that tells you exactly how much pressure the dollar is under right now. The dollar index this weekend is back to February 27th levels. February 27th. That is the day before the U.S.-Israeli airstrikes that began the Iran conflict. The dollar has completely erased every gain it made during 7 weeks of war. Every flight to safety dollar surge, every inflation fear dollar strengthening, every geopolitical risk premium that drove the DXY higher, all of it gone in a single week. Now here's why that number is the most important silver data point nobody mentioned on Friday. Before the Iran conflict began, when the dollar was at exactly these same levels, silver was trading at $93 to $95 per ounce. The macro conditions that produced a $93 silver price, dollar at current levels, oil at near current levels, rate expectations at near current levels, are identical to the conditions that exist right now. Silver is at $79.60. It was at $93 with these same conditions 53 days ago. That $13 gap is not explained by any fundamental change in silver supply or demand. The deficit is wider in 2026 than it was in February. Chinese demand is higher. Indian premiums are higher. COMEX inventory is lower. Every single supply and demand variable has moved in a direction that should push silver higher than February, not lower. Something is suppressing silver relative to where macro conditions say it should be. And at 6 a.m. tomorrow, when European and Asian liquidity combine and institutional desks reprice everything simultaneously, that suppression faces its most direct test of the week. Now let me tell you about Kevin Warsh, because tomorrow is not just a Monday. Tomorrow is the day that could define Federal Reserve policy for the next 4 years. Kevin Warsh's Senate confirmation hearing begins tomorrow, Monday, April 21st, 2026. Warsh is Trump's nominee to replace Jerome Powell as Federal Reserve Chair. Powell's term expires May 15th, 26 days from now. The confirmation timeline is extraordinarily tight. Here's what the market knows about Warsh that makes tomorrow's hearing a binary event for silver. On January 30th, 2026, when Warsh's nomination was first announced, silver crashed 39% from its recent peaks in a single trading session. 39%. That was the worst single-day silver decline since March 1980, 46 years ago. Just the announcement of the nomination. Not a hearing, not a confirmation. An announcement. Tomorrow is the actual hearing, with Warsh sitting in front of cameras under oath, answering direct questions from senators about inflation targeting, interest rate philosophy, Fed independence, and monetary policy outlook. And here is the critical detail that makes this hearing uniquely dangerous for silver volatility. The FOMC blackout period began Saturday, April 18th. For the next 12 days, every current Federal Reserve official is completely prohibited from making any public statement about monetary policy. No Fed governor can respond to what Warsh says. No Fed president can clarify. No Fed official can provide any counterweight to whatever market interpretation forms around Warsh's testimony. If Warsh says something hawkish, signals higher rates, tougher inflation stance, slower path to cuts, and the market interprets it as dollar bullish, silver faces paper market selling pressure. But the physical market in India paying $101 today on Akshaya Tritiya does not care what Warsh says. The Shanghai bid at $94 does not care. The 241.8 million ounces of May COMEX paper claims against 76.88 million real ounces does not care. If Warsh signals dovish, treats war-driven inflation as temporary, open to rate cuts, supportive of economic growth, the dollar weakens and silver gaps toward $87 before most American retail investors have finished their morning coffee. Either outcome creates movement. The Fed cannot soften either outcome for 12 days. This is maximum binary volatility with zero institutional safety net. Here is the Iran dimension of tomorrow's 6 a.m. trigger, and I want to give you data that goes beyond the headlines, because the headlines are dangerously misleading right now. The ceasefire between the U.S.-Israel coalition and Iran expires Tuesday, April 22nd. That is 36 hours from tomorrow's 6 a.m. trigger window. Markets this week priced in a permanent Hormuz reopening. WTI crude crashed nearly 20% since the ceasefire announcement April 8th. Stocks hit all-time highs. Risk assets surged across the board. But here is what actually happened at the Strait of Hormuz during the ceasefire period. Iran charged tolls exceeding $1 million per ship to transit. In some documented cases, $1 million per barrel of oil. On the first full day of the truce, 4 ships carrying dry cargo passed through. 4 ships. Before the conflict, 100-plus vessels transited daily, carrying 20% of global oil supply and 18% of global LNG. 4 ships versus 100-plus. The strait is not open. It is operating at approximately 4% of pre-conflict throughput at economically prohibitive toll rates. Energy traders who built positions on full Hormuz reopening are going to discover this throughput data in Monday morning's shipping reports. When they do, the oil peace premium that drove the 20% crude price drop begins reversing. Oil moves back toward $95. Inflation expectations reaccelerate. The dollar reasserts, and silver, which has been suppressed by ceasefire optimism, faces a recalculation. But here is the asymmetry that makes 6 a.m. tomorrow a trigger, regardless of which direction Iran breaks. If the ceasefire holds and talks progress toward a genuine deal, oil stays lower, inflation fears ease further, and the Federal Reserve has a clearer path to rate cuts. Lower rates mean a weaker dollar. Weaker dollar means silver denominated in dollars gets more expensive. Silver rallies toward $87 on the dovish rate cut path. If the ceasefire collapses before Tuesday's expiry, which remains entirely possible given that Iran has not confirmed the terms Trump publicly described, and no second round of talks has a confirmed date or venue, oil spikes back above $95, inflation fears explode, and silver gaps up as a hard asset inflation hedge simultaneously with a geopolitical safe haven. Both scenarios push silver higher from $79.60. The direction of oil determines the mechanism, but not the silver destination. That is, the asymmetric setup that has professional silver traders positioned long going into tomorrow morning. Now I want to give you something completely different, something nobody's talking about this weekend, the Freeport-McMoRan earnings dimension. Freeport-McMoRan reports earnings this week. FCX is one of the world's largest copper and precious metals mining companies, with significant silver production as a byproduct of copper mining. Their quarterly report will contain something more valuable than the earnings number itself: direct commentary from mine operators about physical market conditions, delivery demand, and forward pricing. When Freeport's management discusses silver market conditions in their earnings call, they are not talking about paper prices or futures charts. They are talking about what buyers are actually paying, what physical demand they are seeing from industrial customers, and what their forward contract book looks like. This is ground-level physical market intelligence that COMEX prices do not capture. In the last 2 Freeport earnings calls, silver physical demand commentary from management has moved the spot price by $2 to $3 within 24 hours of the call. This week, with the COMEX May delivery crisis 9 business days away and physical premiums at historic highs globally, whatever Freeport says about silver market tightness will carry extraordinary weight. If Freeport confirms what the premium data already suggests, that physical silver is genuinely scarce, that industrial buyers are paying above spot, that forward order books are tight, the confirmation from a primary producer will accelerate the institutional buying that is already building ahead of May 1st notice day. This is the earnings catalyst that the silver market is not pricing in, and it lands this week on top of everything else already in motion. Let me talk about the stagflation trap that makes tomorrow's 6 a.m. window specifically dangerous in a way that has no historical parallel in the past 45 years. March 2026 CPI, 3.3% year over year. Monthly jump of 0.9%, the steepest since June 2022. Simultaneously, Q4 2025 GDP revised down to 0.5% from initial 1.4%. High inflation, low growth. Classic stagflation confirmed in official government data. Here is why stagflation specifically supercharges silver's Monday trigger. In a normal inflationary environment, the Fed raises rates. Higher rates strengthen the dollar. A stronger dollar puts pressure on silver prices in the short term, even as inflation supports them long term. The Fed's response to inflation creates a headwind for silver. In stagflation, the Fed cannot raise rates aggressively. Raising rates in a 0.5% GDP environment risks tipping the economy into recession. The Fed is trapped between fighting 3.3% inflation and not crushing a barely growing economy. That trap means real interest rates. Nominal rates minus inflation stay negative or near zero for longer. And negative real interest rates are historically the single most powerful driver of silver price appreciation. Between 1973 and 1980, the last sustained stagflation period, real interest rates were consistently negative. Silver went from $2.50 to $49.45 during that period, a 178% gain. The structural conditions driving that move are present again in April 2026 for the first time since that era. Tomorrow morning, whatever Warsh says in his confirmation hearing will be filtered through this stagflation lens. A hawkish Warsh, who signals aggressive rate hikes to fight 3.3% inflation, is simultaneously signaling willingness to crush a 0.5% GDP economy. Markets will question whether that is credible. An incredible hawkish stance produces the same result as a dovish one: uncertainty about real interest rates staying negative, which supports silver. The stagflation trap has no clean exits, and silver historically wins in every version of the stagflation scenario. Here's the retail sales data that lands Tuesday morning and why it makes Monday's positioning critical. March 2026. Retail sales reports. Tuesday, April 22nd at 8:30 a.m. Eastern. This is the first major consumer spending data since the ceasefire announcement. The consensus expectation is a modest increase, but hidden inside the retail sales report is the consumer discretionary component, what Americans are spending on non-essential items, and that number is expected to show significant weakness. University of Michigan. Consumer sentiment is at an all-time low right now, all-time. Not a recent low, not a post-pandemic low, the lowest reading in the history of the survey. When consumers feel this financially stressed, they cut discretionary spending. A weak retail sales number Tuesday confirms stagflation, low growth, high prices, shrinking consumer activity, and accelerates the institutional rotation into hard assets that is already underway. Professional silver traders know this retail sales report is coming Tuesday. They know a weak number is likely given all-time low consumer sentiment. They know a weak number accelerates the stagflation narrative and supports silver, which means the smart positioning happens Monday, before the data lands Tuesday morning. The Monday trigger is partly a pre-positioning event ahead of a Tuesday data release that the market expects to be silver bullish. Let me put all 6 dimensions together because this is what makes 6 a.m. tomorrow unlike any Monday open in silver's recent history. Dimension 1, the dollar is at pre-war levels, but silver is $13 below pre-war pricing. Pure mechanical catch-up required. Dimension 2, Kevin Warsh confirmation hearing creates maximum binary volatility with zero Fed safety net for 12 days due to FOMC blackout. Dimension 3, Iran's ceasefire expires 36 hours after the Monday trigger window. 4 ships per day versus 100 plus. Oil market is priced for a deal that does not yet physically exist. Dimension 4, Freeport-McMoran earnings this week will provide ground-level physical market confirmation of what premium data already shows. Dimension 5, stagflation confirmed at CPI 3.3% and GDP 0.5% creates a Fed trap where every policy option supports silver. Dimension 6, retail sales data. Tuesday creates pre-positioning incentive Monday. Professional money moves before the data, not after. 6 independent forces, all active simultaneously, all pointing the same direction, all converging on a 90-minute window starting at 6 a.m. tomorrow morning. Silver at $79.60. Tonight is the last price before all 6 of these forces get simultaneously priced into a market with 76.88 million ounces of registered physical silver against 241.8 million ounces of paper, claims 9 business days from delivery deadline. Set your alarm for 6 a.m. because whatever prints on silver at 6:01 a.m. tomorrow morning will tell you everything about which way this market breaks. This is John A.G. Stacker Intelligence. April 19th, 2026. Do your own research. Consult a licensed financial advisor. This is education only. Stay sharp and stay stacking.